Hello and welcome to the Mid-Year Perspective from StockCharts. This is Arthur Hill, Chief Technical Strategist at TrendInvestorPro.com. And today I want to talk about some seasonal patterns coming up in the next few months. We'll look at bonds, we'll look at stocks, we're going to test the best 6-month strategy, see how it compares to the best 8-month strategy, and show how adding some long-term market timing can help. And then at the very end, I've got some monthly charts to show you. So we're going to start off with a seasonality chart here at StockCharts, and this is monthly seasonality for the S&P 500, and these are the percentage of months in which it closed higher. And there you can see 100% of the time in April, June, and July, and November. But this, of course, is only over a 5-year period, as you see down there. So I'm going to open this up a little bit to the maximum to 20 years. And we can see a different picture starting to emerge. Best month by far is April, followed by November, which is a very close second. 79% of the time, it's higher. But what I can see here is I can see basically 5 months that are really standing out. October, November, December, and then we have to skip a few, and then April and May. So those 5 months are really the best 5 months in the market. And you say, well, how do I get to those 5 months? Well, you can't really hop around because then you have to be out of the market in January, February, and March. So you'd have to maybe do a bridge here and form an 8-month seasonal pattern. We're going to get into those in a minute here. But excluding these 3 months, you can see that these summer months are the weakest: June, July, August, and September. But they're not exactly weak because a little more than half the time they do close higher. But if you look at the average gain, September is an average loss, August is an average loss, and June is an average loss. Now, keep in mind, we're talking averages over a 20-year period. Now, another thing I can do here is I can take this slider and I can just move it over. So I can see a 20-year period from 1990 to 2009. And this is an interesting period because it precedes the big bull market that started, of course, in 2009. And here you can see the weakest 4 months are right there in the summer. June, July is the weakest of all, August, and then September. So this tells me that maybe, looking forward into July and August and September, we could be coming into a little bit of seasonal weakness. So let's compare stocks to bonds. And to do that, what I'm going to do is I've got seasonality of SPX there, and I'm going to pick a symbol to compare it. And I'm going to pick UST, that's the US Treasury note, and that is a continuous futures, I believe. I'm not going to pick TLT because it only goes back to 2003, and I would like to go back to at least 2000, 2001 for this. So I'm going to click Go, and we're going to get a seasonality chart comparing the performance of those two. It's like a price relative to see when stocks outperformed bonds. And I'm going to open this up to 20 years so we can get the max there. So if we look at this, another picture emerges similar to what we've been seeing. You can see that as far as stocks outperforming bonds, April and November are the big months. Also big months in May, and then September, October, and December. And then August is the worst month. That's when bonds tend to outperform stocks. Only 37% of the time stocks outperform bonds in August, and the average outperformance was underperformance of 1.7%. And you can see June's not that good of a month either. And actually neither are January or February. But there's that little patch right there in the summer that shows when stocks are outperforming or underperforming bonds. And I can also just put UST up here to see what it looks like on its own. So we'll just do UST. That's UAR, not sure what that symbol is. I'll go ahead and remove this symbol, and we'll just look at bonds. And I'll stretch that over the 20-year period. So this is when bonds are up. Which months are bonds strong? And there, no surprise there, August is the strongest month for Treasury bonds, up 89% of the time. January is the next strongest, followed by July. So it looks like July and August are pretty strong months for Treasury bonds historically. Now, before moving on and looking at some more seasonal patterns, let's look at bonds versus stocks. This is the U.S. Treasury note. This is a monthly bar chart for each one. And you can see Treasuries had this huge corrective period and underperformed stocks. You can see Treasuries basically decline from 2012 until 2018. And during that period, stocks went on a pretty good tear. But we look at what happened to the stock market recently. You can see that basically the S&P 500 has been chopping around, and it is up since the beginning of 2018 with the bounce that it's had over the last 3 months or so. But if you look at U.S. Treasury note 10-year, it had this big breakout here, and it's at a new high. And if you put that on a daily chart, you're going to see what looks like kind of a cup with handle or some sort of a bullish consolidation there. So if you look at these two charts, which one would you say is stronger? Well, clearly the Treasury note here is the stronger of the two charts over the last 2 years or the last year and a half because of this big breakout and 52-week high. So I'm going to hop over to trendinvestorpro.com and look at a post that I wrote a couple months ago. And it's one I'm going to do at the beginning of every year from here on out. And basically, I'm going to look at monthly seasonality using a new twist on that. And that new twist is by looking at the equity curves for each month over the last 20 years, or actually 30 years. Now, what I did is I ran a back test, and the back test extended 30 years. And basically for the back test, I just owned 1 month. And you can see there are the 12 months. And I wanted to see what a portfolio would look like if it just owned 1 month, because that way we can compare performance. And you can see the compound annual return here is positive with big months in March and April. May's pretty good. October, November, December. So big months. And then we see where the weak spot is: June, August, and September. And July is actually a fairly strong month. 0.91% is the compound annual return. Now, don't take these numbers as like a gain or a loss you can expect in the future. It's just to compare the relative performance. But we can see that clearly August and September are negative months, and June is as well. And let's look at some individual equity curves next. So I'll just show a few individual equity curves. We don't need to look at all of them, but basically, you start in 1990, and if you bought at the beginning of June and sold at the end of June for 30 years, this is how your portfolio would go. It'd be down, up, down, flat. So, June is probably more negative than positive here. You had a big June last year, and that was the exception. And then we look at July. You can see July was up the first 10 years, and then down into 2008, 2009, and then with the bull market, July was a good month. So I'll give that a slight bullish edge for July, which is coming up here. And then August. Now, what stands out here? Well, clearly there's a negative bias here for the month of August. So, July from a seasonal perspective still looks okay, but August does not. And then if you look at September, it does not look that great either. You had a pop in the late 90s, and then after the dot-com bubble burst, a decline. But overall, I think September is one of the weaker months. So now let's backtest some seasonality, and we're going to start with the best 6 months strategy, which is buy in November, sell in May, and go away. And this, of course, was popularized by Yale and Jeffrey Hirsch, and they, of course, put out the Stock Traders Almanac. And I'm sure you can get that on the StockCharts bookstore. So I've got Amy Broker here for backtesting this strategy, and we're going to buy on the first trading day of November and sell on the first trading day of May. So simple is the 6-month strategy. And you can see the compound annual return down there is 4.92%. So you get around 5% compound annual return for being invested just 6 months out of the year. You would have had to gone through a drawdown, though, of 34.4%, and you would have had 80% winners and 20% losers. And by the way, I am testing from January 2000 until July 1st, 2020. And the reason I'm doing that is because I want to include a couple of market cycles in any back test. And here are the signals. And so if I back this out to 2000, you can see that, we're going through a bear market, a bull market, a bear market, and then a huge bull market, and then some serious chaos. And the green and red arrows show the signals. And so this is just timing based on the best 6 months, according to the Stock Trader's Almanac. So you would have been in here just before the run up, but you would also have been in during the big drawdown and gotten out there after the oversold bounce. So this next chart shows the equity curve for that strategy. If you had started it at the beginning of 2000, and you would have done pretty well during this bear market here into 2003, and then grew equity, but you would have suffered during the financial crisis and then gained as the bull market extended. So it keeps pace with the stock market pretty good. The blue line is buy and hold for SPY. But you can see buy and hold is at 327,000 from an initial 100,000 here to begin with. And the 6-month strategy is at 267,000. So buy and hold is still outperforming the best 6 months strategy. And if you look at the drawdowns here, the drawdowns are pretty heavy. You can see here that we had 20% drawdown in 2001, and then in 2008, the 35% drawdown, and a 30+% drawdown here in 2020. So the reason they call it the best 6-month strategy is because if you test the other 6 months, and instead of selling in May and going away, you buy in May, and then you sell on November 1st, you can see the returns are much worse. You have a 1.18% compound annual return, a bigger drawdown of 43%. Now, you still had 16 winners and 5 losers, but you'll see that the equity curve is a lot worse. In fact, you don't even keep up with buy and hold with this equity curve. If you had done the opposite, you would have just gotten above water in 2018 there. So you're just above the $100,000 start instead of being up near this 267 area with the best 6-month strategy. And if you look at the drawdowns, there are some pretty big drawdowns that stayed drawdowns. So clearly there's some value in the best 6-month strategy, but we can improve it by trading the best 8 months. So as I showed when we started looking at the StockCharts seasonality tool and we look at the equity curves, that there clearly was a weak spot within the year, and that weak spot went from June to July, August, and September. July was a bit of the exception, but I'm going to keep that 4-month period there and call it the worst 4 months, and we'll test if we bought and held during the best 8 months. And on this test, you can see we improved the compound annual return. We got 6.21% annual return, but we still have that pesky drawdown because you're not doing any market timing, and we're going to get into market timing next year. But you had 80% winners and 20% losers. And if we look at the equity curve for such a strategy, you're starting out at 100,000 and you're a little bit flat, and then you grow during a bull run. But there you have that big drawdown into 2008 and 2009, participated in the bull run, and then got choppy. But you can see the ending equity is at 344,000. So you end up outperforming buy and hold just by being invested 8 months out of the year and avoiding the worst 4 months. Now, I'll show you that drawdown chart because it is pretty important, and that's what we're going to try and work on in the next segment. There's the big drawdown in 08, and then a 30+% drawdown in 2020. So if I reverse the rules and instead I own the worst 4 months and I'm out of the market during the best 8 months, you can see your compound annual return is slightly negative, 41% drawdown. You still had 76% winners and 5% losers, but those losers must have been some dandies. And here's the equity curve. You can see it's pretty flat. So there was no point over the last 20 years in owning that 4-month stretch from June to July to August and September. And if we look at the drawdowns, it's just one big drawdown. You go into drawdown and you stay underwater the entire time pretty much. So here's a table comparing the best 6 months to the worst 6 months. You can see the total net profit just blows the worst 6 months out of the water. Compound annual return is much higher. The drawdown was lower for the worst 6 months, and the win percents were around the same. But you can see during the worst 6 months, the average loss was much higher. But the real action is in the best 8 months, as you can clearly see. You're getting a total profit of 244%. If you had just avoided those worst 4 months, because they returned a negative amount of money over that period, over the last 20 years, you can see that the win-loss rates are about the same, but you can see that the average loss during the worst 4 months was 15%. In fact, the average loss during the best 8 months was 10%. But the thing is, you had an equal average gain roughly, and you won 80% of the time. And here you had an average gain that was a third of the average loss. So clearly there are pressures on the market during that worst 4-month period. So you might think that 6.2% compound annual return with the best 8-month strategy is no big deal, but actually it is a big deal because it is outperforming buy and hold with dividends, and it is blowing away the S&P 500 without dividends. So we were basing the trades on SPY with dividends for the best 6 months and best 8-month strategy. And how do these two look? Well, you can see S&P 500 without dividends over the last 20 plus years, up 3.73% per annum, compound annual return you would have gotten. And your drawdown would have been 57%. And if you had SPY with dividends, your compound annual return would have gone up to 5.65%, and your drawdown would have been 55%. So still big drawdowns. And so you're only getting 5.65% because of that lost decade. And then you've been pretty much chopping around since January 2018 here. But the reason I want to show you this chart as well, we're setting the benchmark. We want to beat 5.65%, and we want to get a better drawdown. And if you look at this, I'm going to use the S&P 500 for signals on the moving averages, but I'm going to trade SPY. And the reason is because I don't want any ambiguity in the signals, because when you adjust for dividends, you change historical prices. And so if you look here, you can see that high from 2000. Well, the S&P 500 just got to that high in 2007. And if you look at SPY with dividends, well, it got well above it. And then you can see, if you look at that 2008 high, SPY got above it in 2012, and the S&P 500 didn't until 2013. So when you put back the dividends, that kind of gives an upward bias to prices. And I just want to take the ambiguity out. So these next tests will use the S&P 500 for signals and SPY with dividends, total return for trading. All right, so let's just test a basic moving average crossover here. SPY we're going to buy, and we're going to use a cross when the S&P 500, the 50-day crosses the 200-day, the golden cross, and we sell when the 50-day crosses below the 200-day, the death cross. And here you can see the list of trades, and then we have the compound annual return at 6.2%, not bad. but the drawdown was around 34%. That's pretty big. 7 winners and 2 losers. So it's not a very active system. You're not going to get a lot of signals. And if you look at the trades here, you're going to see some good trends, some whipsaws, and some bad signals, if you will. You would have avoided the bear market in 01 and 02, caught a couple of big moves with a couple of whipsaws in between, avoided the financial crisis, caught some more nice moves with whipsaws in between, and then you would have gotten in here in January 2019 and out in March 2020 with a big whipsaw. And there are the signals for when the S&P 500 50-day crosses above the 200-day. But what about the equity curve? Because that really tells us how much money we're making or losing. And so if we look at this equity curve, it's not bad. You're flat because the 50 days below the 200-day, and then you get a rise because you're in the market. You go flat in the financial crisis. You get in the trend. You get whipsawed. You get in the trend. You get whipsawed. You get in the trend. And you can see it's outperforming buy and hold, but you had a big drawdown. And if we look at these drawdowns, the biggest drawdown was here in March 2020. So when I look at this drawdown here, it was looking great in 2010, 2011, and even in the financial crisis in 2001, 2002. But that crash we had in March 2020 laid out the weakness of the golden cross. And I think we need to shorten that 50-day to something like a 20-day or maybe even a 5-day. So let's see how these different moving average crossovers stack up against buy and hold. Remember, we're using the S&P 500 for the signal, and we're using SPY for the trading vehicle. So compound annual return, SPY with dividends, since 2000, 5.62%. That's our benchmark. We're trying to beat that. But we're also trying to beat this maximum drawdown, which was 55%. And you can see with the 5,200 cross, we got a higher return, good, but the drawdown only dropped to 33%, which isn't so good. And you know, you only had 9 trades, not a very active system for 20 years. And then if you go to a 20-day, 200-day cross, you can see your annual return drops to 5.7%. So you're still edging out buy and hold, but your drawdown stays around 32%. So that's still pretty high. If we go to a 5-day moving average with a cross above and below a 200-day moving average, we get buy and hold type returns, and our drawdown drops to 20.62%. That's a tolerable drawdown considering. And you can see you got 47% winners. Your average gain is 12%. Your average loss is minus 2.31%. Now you need some sort of moving average for smoothing because if you just go to a cross above and below the 200-day, you get a 5% return, the lowest of the group. You still get a 21.5% drawdown, and you get a much lower win rate because you're getting a lot of whipsaws. There you can see that low average gain. So I think that the sweet spot for this moving average system strategy here would be the 5-200 cross for the S&P 500. That tells us when we want to be in the market and when we want to be out of the market, when we want to take risk and when we want to take risk off the table and go risk averse. So I'm recording this on July 3rd because I'm going to be on vacation the following week, and you'll be seeing this that week after. But this is still a longer-term strategy that you can apply going forward. And right now, you can see the 5-day move below the 200-day in early March. That was a timely signal, would have gotten you out. Of course, you would have missed this big advance because moving averages lag, but that's the way they do. And you got a crossover there in late May. So right now, the 5 days above the 200-day, and that suggests a risk-on environment, more or less. And you not only use this for broad market timing, but also to kind of set your risk tolerance. So if the 5 days above the 200-day, you want to be more risky, but the 5-day goes below the 200-day, then you want to take a little bit risk or take some risk off the table because that could be a bearish development. Now, if we go back to our seasonal patterns, you can see that July has been okay, as we showed, but August and September not so okay, with an average loss. And so I showed you the best 8 months, the worst 4 months. So if we get that 5-day cross in September or even in July, I think it would carry a little more added weight to be more risk averse because we are in the worst 4-month period. So those are two things to watch for. We're in the worst 4-month period, and watch that 5-day and the 200-day for the S&P 500. So at trendinvestorpro.com, I will be following the dance of the 5-day and the 200-day as we get deeper into summer and August and September hit. The worst 4 months and a bearish cross in those two moving averages would not be a good thing. If you're interested in trendinvestorpro.com, please visit the website. Subscribers that are also members of StockCharts get access to the ETF Master Chart List, over 200 ETFs, as well as the Essential Breadth Indicator chart list. I do regular updates for a market timing strategy using breadth indicators, and it has been quantified. I've got an ETF ranking and grouping report, and there's a premium page that has some longer-term articles, and I talk about some different strategies that I've been covering. There's the monthly seasonality, and I've got a 5-part strategy on using the Stoke Close indicator for rotation, trend following, and as part of a strategy that involves profit taking. So check that out if you're interested. So with the 2 minutes or so that are left over, I've got a couple of monthly charts that I want to show you. First up is gold, and this is one of the strongest charts in the market right now. You can see the big correction that overshot the 61.8% retracement, but you got this kind of rounding bottom there and a massive breakout there in the summer last year. A little consolidation and then a continuation higher. And so it looks like gold is headed for a date, GLD it is, with those 2011 highs around 185. The trend is strong and it is a leader. The other one that is leading with a major breakout is the biotech ETF, IBB. And you can see this big run up, and then it just stalled for several months. And this chart was featured in April 23rd, in fact, on trendinvestorpro.com. And you had the breakout there. The gold chart was also featured on April 23rd because I was looking at some longer term charts that had some massive breakouts working. But IBB went nowhere for like 5 years and then started breaking out in late 2019 and finished that breakout in 2020 here and is near a new high. So this one looks very bullish. Now, this last chart is really just a chart of interest, but basically it shows SPY and QQQ, and you can see they were moving in lockstep up until October, November 2019. And this price relative shows QQQ relative to SPY doing the flat thing, and then turning up in December 2019, and then that accelerating in outperformance into 2020. And look at that, you can see QQQ making new highs here in June, higher highs and higher lows, whereas SPY is flat to down in June here. And what that has done is push the correlation coefficient there below 0.50 for the first time since September 2018. And we got a pullback in the markets then. Now, that's not a signal, it's just something of interest. All right, so that concludes this presentation for the mid-year outlook. Thank you very much for tuning in and enjoy the rest of your summer.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.